A signal just triggered on the S&P 500. For the last 8 weeks, over 50% of investors have been bearish on the market. This chart shows us the number of consecutive weeks where over 50% of investors were bearish. And we've never seen this much pessimism over the last 35 years. Not during COVID, 2008, the dot-com collapse, or the 1990 oil price shock. And the panic isn't just in surveys. The Volatility Index shot up to a reading of 52 on April 8, following the new tariff announcement. This was the highest level since the pandemic rocked markets in early 2020, and nearly 3 times higher than the historical average. Not only that, the VIX also closed above 45 for 3 straight days during this period. That's only happened twice before, once during the COVID crash and once during the Great Financial Crisis. Peaks like these in the fear index mean investors are running for the hills. That's mostly because of fear that Trump's tariffs could crush corporate profit margins, disrupt global supply chains, and reignite inflation, which would prompt the Fed to raise interest rates again, or that it could lead to a recession. To understand what's going on, we need to talk about investor sentiment, because right now it's on the floor. You need only glance at the headlines now and then to see that. Bank of America's fund manager survey fell to 1.8 in April after peaking following Trump's election. The current level of sentiment is the 5th lowest on record, behind 2001, the Great Financial Crisis in 2009, the trade war during Trump's first term in 2019, and the collapse of Silicon Valley Bank in 2022. The Fear and Greed Index is pointing to extreme fear, recently dipping below 10, a level last seen during the bear market of 2022 and during the bottom of the March 2020 crash. The AAII Bears is showing 62% of investors have a bearish outlook. This is a weekly sentiment survey which polls investors on their 6-month outlook for the economy, bullish, bearish, or neutral. Right now, we're way up here. 62% of investors have a bearish outlook. That's higher than the bottom of the 2022 bear market or the 2020 market crash. You'd have to go all the way back to the depths of the financial crisis in 2009 to find a reading this bleak. But extreme fear isn't always a reason to sell. In fact, it's the opposite. When everyone's bullish, upside is limited because all the good news is already priced in. But when everyone's bearish, that's when markets can surprise to the upside. Historically, some of the best long-term buying opportunities have come when investor sentiment was in the gutter. And this is why sentiment surveys like these are often seen as contrarian indicators. This is the classic bit of investing advice encapsulated so eloquently by Warren Buffett. Be fearful when others are greedy and greedy when others are fearful. In other words, go against the crowd. When everybody rushes for the exit, turn around. With the AAII survey, extreme readings are often seen as market turning points. Historically, the 5 other times that bearishness was above 60%, average S&P returns over the next 6 months were more than 14% and more than 22% over the following year. If history repeats, this could bring markets back to an all-time high. So a significantly elevated bearish reading, like we see today, could indicate the market is ripe for a rebound. The VIX Spike tells us a similar story. In March 2020, the VIX hit 82 as COVID lockdowns gripped the globe. Fear was on high, and nobody knew how long the market collapse would last. But the market bottomed just 2 weeks later, and the NASDAQ 100 actually doubled within a year. So if history is any guide, this VIX spike could be the kind of fear-driven flush that sets the stage for a powerful rebound. But, and this is a big but, we have to talk about 2008. Because in 2008, the VIX also spiked, and the market did not recover right away. It kept falling for months. From the VIX spike in September to the market bottom in March, the NASDAQ 100 dropped another 21%. Why? Because that panic was backed by real systemic risk, failing banks, frozen credit markets, and a global economy in freefall. So the question now is, are we in a 2020 style overreaction, or are we looking at the start of another 2008 style meltdown? On the one hand, sentiment indicators and history indicate an oversold market ready to bounce back. And besides peaking fear indices, there are some indicators that the economy could prove resilient. For example, March added 228,000 jobs, many more than expected. GDP growth has also remained steady, but that could change. Trump's historic tariffs have sparked a trade war with China and could extend to the rest of the world as well when the pause ends in July. A trade war could reignite inflation, prompting the Fed to raise interest rates and potentially tilt the economy into a recession, tanking the recovery and making the scenario more like 2008 or even worse. But just because markets are falling doesn't mean a recession is guaranteed. Since 1928, the US has seen 27 bear markets, but only 15 recessions. That means nearly half of all bear markets didn't lead to a recession. And even when they do, the pain tends to be short-lived compared to bull runs. The average bear market lasts less than a year. The average expansion over 5 years. So how long will this downturn last? Of course, it's impossible to say. Maybe the tariffs spark a recession, maybe inflation comes roaring back, and maybe we're in for a rough 12 months. But maybe, just maybe, this is one of those moments where the crowd gets it wrong, where fear and panic lead to an oversold market ripe for a comeback. As the Oracle of Omaha famously said, be fearful when others are greedy, and greedy when others are fearful. The best time to buy is often when it feels like the worst. So when considering indicators like sentiment and so on, ask yourself, is this really the end of the bull run, or a brief blip before the start of another? At Capital.com, we'll continue to keep you updated on the latest market developments with in-depth videos like this one. Hit subscribe to stay tuned. Thanks for watching.